$100,000 in dividend stocks sounds like a dream number, a milestone most people work years to reach. But here's what nobody tells you: what it actually pays you monthly. Not annually, not in theory, monthly. The actual cash that hits your account every 30 days. I'm about to show you 3 different $100,000 portfolios: conservative, moderate, and aggressive. The exact monthly income each one generates, what taxes do to that number, and most importantly, what that monthly income actually buys you in real life. By the end, you'll know if 100,000 is enough or if you need to keep building. Let's start with the math everyone gets wrong. The formula is simple. $100,000 times the dividend yield equals annual income. Divide by 12 for monthly income. But most people stop there. They don't account for taxes, they don't consider dividend cuts, they don't think about whether to reinvest or withdraw. And they definitely don't ask the most important question: is the monthly income enough to matter? Let's break down 3 real portfolios with 3 very different outcomes. Portfolio 1. Kamuatsino Konfanimi Mon. Conservative at 3% average yield. Think dividend aristocrats, blue chip stocks, quality ETFs. 100,000 at 3% yields 3,000 annually. Divide by 12. That's $250 monthly before taxes. Example holdings: Johnson & Johnson, Procter & Gamble, Coca-Cola, Microsoft, Visa. Companies that have paid and raised dividends for decades. Rock solid, boring, safe. The monthly income feels small. $250 doesn't change your life. It covers a car payment or part of rent, maybe groceries for a family. But here's the advantage: these companies grow their dividends. 3% today becomes 4% in 5 years, 5% in 10 years, as they raise payouts. Your yield on cost climbs while the portfolio value likely grows too. This is the sleep well at night portfolio. You're trading current income for safety and growth. $250 monthly now, potentially $400 monthly in a decade without adding a single dollar. The question is whether you can afford to wait that long for meaningful income. Because Portfolio 2 delivers more cash immediately. Portfolio 2, moderate at 4 to 5% average. Yield. This portfolio is a mix of dividend aristocrats, REITs, and solid high-yield stocks. 100,000 at 4% yields 4,000 annually. That's $333 monthly. At 5%, it's $416 monthly. Example holdings: SCHD, Realty Income, ABV, Verizon, Altria, along with some aristocrats like PG and JNJ for stability. Now we're talking real money. 300 to 400 monthly covers utilities, groceries, or a significant chunk of rent. It's meaningful cash flow. The yields are sustainable. These aren't trap stocks paying unsustainable dividends. They're established companies and funds with long track records. You're balancing current income with reasonable safety. Not bulletproof like Portfolio 1, but not reckless either. The dividend growth won't be as aggressive, but you're getting substantially more income today. 400 monthly is 4,800 annually. That's a real contribution to your budget. It's the difference between tight and comfortable for many households. But some people need even more income immediately. That's where Portfolio 3 comes in, and the trade-offs get serious. Portfolio 3, aggressive at 6% or higher average yield. This portfolio is heavy on REITs, high-yield stocks, and higher-risk dividend plays. 100,000 at 6% yields 6,000 annually. That's $500 monthly. At 7%, it's $583 monthly. At 8%, $667 monthly. Example holdings: high-yield REITs, BDCs, Altria, AT&T, high-yield ETFs, maybe some preferred stocks or closed-end funds. 500 to 600 monthly is serious income. That's $6,000 to $7,000 annually from a $100,000 investment. It covers major expenses. But here's the reality: these yields come with risk. Companies paying 8% aren't doing it out of generosity. The market price is in risk. Dividend cuts happen. Stock prices can be volatile. You're maximizing current income at the expense of safety and growth. These portfolios often don't grow dividends aggressively. Some cut dividends entirely when business deteriorates. This works if you need maximum income now and accept the risks. It fails if you panic sell when one position cuts its dividend by 30%. But regardless of which portfolio you choose, there's one thing that destroys them all. And most people completely forget about it until tax time. Coming up in the next section. The taxes reality check. Every number I just gave you is before taxes, and taxes matter. Qualified dividends are taxed at capital gains rates. 0%, 15%, or 20% depending on your income. Most people pay 15%. Let's take Portfolio 2, $416 monthly at 5% yield. 15% tax means you're paying about $62 monthly in taxes. Your actual take-home is $354. Portfolio 3 at $600 monthly, minus $90 for taxes. You're keeping $510. If your dividends are non-qualified, which some REITs and BDCs pay, they're taxed as ordinary income. That could be 22% or even higher depending on your bracket. $600 monthly becomes $468 after taxes at 22%. Always calculate after-tax income. The IRS doesn't care about your gross dividend yield. They want their cut. And if you don't plan for it, April is painful. Timeline to reach $100,000. Fifth, the timeline to reach $100,000, because most people watching this don't have $100,000 invested yet. If you invest $1,000 monthly at 8% total returns, you reach $100,000 in about 6.5 years. At $1,500 monthly, you get there in 4 years. At $500 monthly, it takes about 11 years. The contributions matter more than the returns early on. In year 1, your returns on 500 monthly contributions are tiny. Your contributions are the growth. This is why increasing income and contribution rate matters so much. Going from 500 monthly to 1,000 monthly cuts your timeline in half. Once you reach 100,000, the dividends and growth start doing serious work. A 5% portfolio generates 5,000 annually. That's meaningful passive income that can be reinvested to accelerate growth further. But here's what that monthly income actually buys you in real life, and whether it's enough to matter. What does the monthly income actually buys you? Let's be honest about $250 to $600 monthly. At $250 monthly covers a car payment, part of rent, basic groceries for one person, or utilities plus internet. Helpful, but not life-changing. $400 monthly covers full utilities, groceries for 2 people, health insurance premiums, or a meaningful chunk of rent. This starts mattering. It's real budget relief. $600 monthly covers rent in low cost of living areas, full grocery budgets for families, multiple car payments, or significant debt paydown. This is where dividend income becomes genuinely impactful. None of these amounts replace a full-time income. $100,000 in dividend stocks is not retirement money for most people. It's supplemental income. A financial cushion. Options. To truly replace income, most people need $300,000 to $500,000 invested. That's when monthly dividend income crosses $1,000 to $2,000 and starts covering major life expenses. You just learned what $100,000 in dividend stocks actually pays monthly. Now here's what to do with this information. If you don't have $100,000 yet, focus on contribution rate. Every dollar you add gets you closer. Automate monthly investments. Increase contributions when income rises. If you're near $100,000, decide which portfolio tier fits your situation. Need income now? Go moderate to aggressive. Building for decades. Go conservative and let dividend growth work. If you're past $100,000, keep building. $100,000 is a milestone, not a finish line. The next milestone is $200,000, then $300,000. Dividend income scales. Double your portfolio. Double your monthly income. The math is simple. Execution is everything. Want to see how dividend income scales beyond $100,000? Watch my video breaking down $100 monthly versus $1,000 monthly versus $10,000 monthly in dividend income. Shows exactly what you need to reach each tier and how your life changes at each level. Click on the screen now, subscribe to this channel, drop a comment with how close you are to 100,000 invested. I'll see you in the next video.